Should we go ahead and get started? Thank you, everybody. Hello, my name is Steve Schmidt. I represent a company called Admodum Investment Holdings. It may say Alternative Investment Resource on your guide, but the description is actually for our holding company. I'm a partner of a private equity holding firm. We specialize in alternative assets, hedge funds, direct private equity, project transactions. Today we're going to talk about how to partner with a family office to close your deal. To my left, we have three distinguished panel members who will be able to address some of the questions I'm going to ask. So why don't we get started? And gentlemen, if you could each spend a couple of minutes and give a background, give your own background.
Sure. Hi, everybody. Nice to see some familiar faces. Hope to meet some new ones. I'm with a single-family office in Houston called Petro Lucrum, historically concentrated in real assets and operating businesses, but it's a generational trust today, investing across asset classes, ultimately concentrated onshore USA, definitely still a continued focus within oil and gas, but we invest in other operating businesses as well. We'll talk a little bit about some of the co-investment things we do as we move along.
I'm Jacques Bazinet, and my partner and I are Talus Holdings. We're a multifamily developer. I got to the space by spending 15 years in operations, 25 years in professional development, and then recently we've been doing multifamily. Talus has been around for over 30 years. We've developed over 5,000 units in the last couple years.
I'm Fadi Eftimios. I'm with Group RMC. We do real estate. We have a very tight niche. We do office and typically in secondary markets, what we call the unloved areas, although we love them. We started out about 20 years ago. It was just a few families buying up property, mainly in Canada, and did quite well. We moved into the U.S. about 10 years ago, and we continue to look for the same type of metrics. We look for very, very high cap rates. We like to buy assets at significant discounts to replacement costs for various reasons, which I guess we'll discuss a bit later on. And we conservatively approach these assets. We like the high IRR, but we don't like the risk that generally comes with that. So we have a little bit of a different philosophy on that.
Thank you. I'm going to start with one question right away. Is ideally, what structure best fits your organizations? So, Tim?
Yeah, well, ultimately, we look at a number of different structures depending on the opportunity. Private co-investment structures oftentimes will come with something that looks maybe more like a traditional private equity structure where we'll look at some sort of, before payout or after payout type scenarios. A lot of times, depending on the scenario, we'll negotiate a variety of different features that may come along with that. At the end of the day, I think that we look to share the risk, ideally with partners, whether they're operators or other capital. And so trying to find a way that affords for that is kind of typically the direction we're looking at. The co-investment portion also typically will be viewed upon as strategic as well, particularly if it's in an area that maybe we don't have the internal core expertise. So these kind of, before and after payout type of scenarios seem to make the most sense versus other scenarios where maybe there's a lot more front-end promotes or different things of that nature. So a lot of time the payout comes first to us and the investment partners, and then there's other incentives that will kind of come along with that.
Go ahead, John.
Yeah, we're just simple people. We like to keep it very simple. So our structure is if we're in a partnership with an investment group, we try to make sure that ownership is shared and we're true partners. So we're not into waterfalls or clawbacks or anything like that. We just, when the investment works, we all make money, and we try to minimize the opportunities where we don't. In 30 years, we've never lost, so it seems to be working. We certainly don't load fees like acquisition fees or securing a new mortgage or disposal fees. We don't charge any of that. We just love having we're more into relationships, long-term relationships, than we are into creating these deals that could be sheltered from loss on one side or the other. We're in the market, and we do the deals as simple as possible to make sure that it's very easy to understand the structure and that we both have an opportunity to benefit as we liquidate the assets.
Our structure is also quite simple, a typical LP-GP structure. We are, as partners, we're LP and GP in each investment. We have skin in the game. Every investment the partners are putting in, generally the biggest amount of equity in every deal. And we are a true and co-investment group. 80% of the investors in our deals are family offices, single-family offices, and about 85% of our investors come along in every deal. So they like our structure, they like our philosophy. We're also, we think, very much like the LP side, the investors, where we don't charge management fees, we don't charge performance fees. So what do? We just take a little bit more equity on each deal, and we don't take it as a promote. We don't take any money out other than the distributions that all the investors get. So our focus is to be investor friendly and make money like our investors on the success of the portfolios that we purchase. And our thing is, in a sense, to be. I don't think there's going to be a lot of you here clamoring for office in suburban markets. That's not a hot topic, and I'll tell you, we've been doing it for 20 years. No one's ever knocked on our door, please, we want office in suburban markets. The more secondary markets, the better. That's never happened. And that's okay with us because demand drives up price. We want to be where there's not demand yet. There is more demand than 5 years ago, but we want to sort of be ahead and be able to, we're in accumulation mode. We're at about 14 million square feet, and our objective is to accumulate as much as possible until the demand shifts really to office space.
Thank you. One step deeper on your structure in your deals. Can you give a recent example of a deal, how it's structured? I mean, you got the summaries, but one you really liked when it comes to mind that flowed the best for you? Start with you, Tim.
Yeah, so again, as I'd kind of pointed out previously, really kind of looking for ways to share that risk is important to us. Where everyone's bringing a certain level of skin in the game. So I think that the deals that have made a lot of sense in some cases have been where there might be a breakdown of a certain cash flow that's used to pay back the preliminary investment. Upon being able to get to that point, then we can see kind of a shift or more of a heads-up approach on distributions. So we've done this within real estate. We've certainly done this within operating businesses, oilfield services, infrastructure-related, and the like. So I think it's really going to end up being kind of that structure that's going to allow for managing that principal risk and then being able to share in that upside.
Jacques?
Yeah, so again, we keep it simple. Regular deals for us look like, because of our 30-year track record, we're able to secure 90% debt. So, a deal for us would be a landowner coming and putting his land up. We open up a capital account for that contribution and then fund the deal that way. And then, disperse on liquidation. So we try to keep it as simple as possible and very high leverage and high return.
Yeah, I think we're really simple as well in the sense that typically we get a deal under contract, and we'll get the deal under contract before we have the financing or equity raise in place. We just raise equity well. We've closed 100% of our deals. We've never not closed a deal, and we've never not got the financing. So we're pretty confident getting a deal under contract and within 90 days getting our DD done, our financing done, and all the equity raised. And we tend to be oversubscribed again. In the co-investment world with family offices, the investors that come along can write big checks, and more often than not, we're asking them to write a smaller check just because we need to leave room for other investors, because we really follow a co-investment philosophy where it's not a JV, and most of our investors can buy the whole deal on their own, but we want to really keep that co-investment philosophy, so we'll leave as much equity as we can to each of the different groups involved. So why do we raise capital now? We're just simply doing more deals and bigger sizes, so we just continue to need to raise.
So if I could just share we've been similar all along. You've just said something that makes it a little different. When we get into each property, we'd rather have a smaller group of individuals participate in each property than to bring. It's true to say that a large percentage of our investors go from property to property, but we'd rather not be dealing with 12 investors. We'd rather be dealing with one or two primary investors. So that's the first time that we are a little different.
Well, we've done a number of deals that were not big. They were just not that big. They're smaller deals, and we would just buy it outright on our own. I mean, it just wasn't big enough to pull in other investors. We try to leave room, but it depends on the deal size as well.
I'm going to switch gears a little bit and talk about new investors. When you're approached by a family office or investor, a new one, what's the process you go through? What's your methodology? Bobby, we'll speak with you.
I find that's a really good question. We have. we see all kinds of things. Some groups like to go do really deep due diligence, and they want to get to know us. They want to get to know our strategy. They talk to our lawyers, our deal people. They want to meet everybody, who makes the sandwiches in the kitchen. They want to know everybody. And one of my partner here, Mike, was just on a due dil trip. We do these due diligence trips where investors get invited along, spend a couple of days with the team, and they'll visit maybe 6 or 7 cities in a couple of days. So Mike just got back yesterday, and they were in Minneapolis, they were in Kansas City, they were in, I forget where else he was. Oh, he was in Cincinnati. They were in Chicago over the last couple of days, and six families went along for the ride, and basically they get to visit the properties, they visit the property managers, they visit the leasing brokers. Some investors like that. They want to go really deep DD, and others just want to get to know us and our strategy, look at our track record, talk to a couple of people. And typically it's all referrals, right? We've been dealing with these guys for 10 years, and this is how it works. We introduce them as quickly as possible to the key people and to our investor relations team, and then we don't do much after that.
Okay, it's a lot already. Jacques?
I don't know how much I could add. It's a people business. So people could say, we're building commercial real estate, or you're working with investors, you're working on pro formas. In the end, it's a people business. And we find that selecting the right people to work with that have characteristics that we are, kindred spirits in is what we look for, rather than looking for a certain net worth or deal points. The people that we work with are worth a lot more to us than the deal points and the documents, or the
Relationship's more important than the capital.
Yeah.
So, Tim?
Yeah, so ultimately we operate as just a single family office, so we don't have any internal funds or structures like that. So co-investment is very much relationship driven for us. I'd say even a lot of the family offices I know, we haven't, sometimes we'll share deal flow if it's relevant. A lot of times we're just comparing notes, but those types of relationships typically get developed over time. I think a lot of the folks that we've wanted to do stuff with, that there's similarities between our family offices, has typically even still taken a couple of years before maybe we've gotten really serious, in part because we're all doing a lot of stuff, and since we're not pushing investment product out to the marketplace, it's really circumstantial. That, and I think we were echoing this conversation before, it's not always about just identifying a capital partner, but really the right capital partner. So if we're going into a particular type of oil and gas, or a particular type of real estate or operating business, we're going to recognize our strengths and weaknesses. And so if that partner brings a certain amount to the table in terms of that expertise on top of sharing that capital risk, that's going to be most important for us. So I think everybody I typically approach, and the same thing goes for other outside managers or strategies that we might get involved with, is it's a relationship building exercise, and I tell people that's just the kind of the nature of the way things have gone. Of course, some of the co-investors that we're active with are folks that the family's been investing with long before even I was involved in. So with the type of liquidity profiles available, generally we're not out there actively trying to develop new relationships, but of course, being in the industry, being in the circuit, so to speak, then obviously we entertain new relationships, but it's definitely takes some time to cultivate that.
I want to go back to that time factor. Our hedge funds, we have about $200 million of assets under management. About 80% of our investors are family offices. We find that it's persevering, sticking with it. We find it could be as much as a year before someone decides to actually invest with us. Do you find that true as well in your businesses? Let's start with you.
Yeah, we do. I mean, it's for various reasons. Sometimes they're closing something else on their own. They have another day. I mean, a lot of family offices have a lot of deal flow. That's their challenge, is to filter down and select a few that they'll actually spend more time. We're doing. We have a new again. I agree with what Tim was just saying there. It's a lot of. We're looking for like-minded people. I mean, we don't. We want to have a 20, 30-year relationship, and that's actually very important for us. And we have a group right now out of Dubai, who I guess we've been talking to them for probably a year and a half or so, and they just made their first commitment. And really, we were hoping to meet face to face, but they're in Dubai and we're not. It's a little bit complicated. We're going to be in Dubai in November, actually. But it took a year and a half, and it was all by phone, and so sometimes it takes longer. But that's all, I would say, within 6 months to a year, typically.
That's a good word. Jacques,
Something that Tim shared brought another thought is we certainly want to work with like-minded people, but Tim also pointed out that we want to work with people who could contribute to the specific initiative. So for example, we've just gone vertical here in Fort Worth, and of course we do it nationally, but one of the sponsors here is actually from Fort Worth and had worked with the city before and helped us with TRWD and Army Corps of Engineers, so they had a lot to contribute on the specific initiative that we were doing here in Fort Worth. So, and we had a connection in regards to their character.
Good point. Tim, anything at time?
Just again, kind of continuing that point of view. I think the best capital partner is somebody who does have something to contribute. If we're to go back to oil and gas, if we're going into, say, the Bakken in North Dakota, where maybe that hasn't been our historical footprint, we're going to want to team up with somebody, particularly that's putting capital in with us, that really knows that market, really knows that rock in this case, knows what works for the development of those types of fields, knows the compliance environment, a lot of those types of things, which, of course, with consultants or expertise you can, and research, you can get to that point. But having somebody who's already been through it, there's really that strategic element. And so that's going to be one of the biggest things we look for, is that strategic element.
Since we're all up here today for a purpose, could you take a few moments and describe your perfect deal and what you're looking at? I know you have categorized it, but can you be a little more specific? Do you want to start?
We haven't found our perfect deal yet. We find a lot of good ones. I mean, if I was to say, we want typically Class A assets. It could be Class B depending on the area, but we're really looking at Class A. We want a high cap rate going in place metrics. True cap rate, 8 would be on the lower end, 9 we like, 10 we start to like it a lot more. But we're not going to pay $200 a square foot for that. We want to come in quite a bit under market. And there was an article that was just written in something we picked up in Memphis. Great asset. It was CBD. I think we got it at a 9 or 10 cap. But the article was saying Group RMC purchased this asset. It wasn't a huge asset. We put it as part of a portfolio, but we picked it up for $14 million, and occupancy has been moving up. The previous buyer had purchased it for $28 million, so we bought it significant. His price could have been totally out to, doesn't mean their price. It's not indicative, but we did buy it at about 60% discount to replacement costs. So we want to buy at a discount. We want to buy a high cap rate. We want to see an upside. We'd rather buy something with a really good cap rate, at 70% occupied, so we can get all the value add component too. That's sort of our in a growing area. That's really what we're looking for. We've done it a lot of times. It's getting tougher to find those deals, and now it comes down to relationships. We bought off Blackstone and some other big groups who have massive portfolios, so we become a preferred buyer. Without that, it's very tough in the markets we're in. We just have that scale now.
Okay. Jacques?
I don't know what I would add, except to say that we also look to work in underserved markets. So we go to second-tier markets. One of our amenities that we offer is training, coaching, and development for our residents. So we for example, in Atlanta, we'd like to be in areas where the population does not have access to those sorts of tools in our absence. So in addition to deal structure and market caps, being in an area where we could actually serve the people that are there is also meaningful to us.
Great. Tim, can you address the energy side, please? What you're looking for there?
Sure. Just even more broadly, I'd say that what I hear a lot internally is that, first and foremost, we're risk managers. So as you can imagine, this is a fourth-generation family office, so the strategies and the deployment of capital isn't so much the get-rich mentality as much as stay rich. So the concept for us is typically going into existing developments or properties or businesses that have that baseline, that have some level of upside associated with it, but we're not trying to go in there and, say, take the oil and gas, discover the next major well, as much as drill the next 20 wells in an existing field, or in any other form of business. Can we expand by deploying more equipment, opening new service lines, new areas of operation? And so it's really a growth capital scenario most of the time these days. Does that mean that we wouldn't look at a ground-up, real estate development under the right circumstances? We would, but I'd say we definitely lean more towards value add or acquiring other properties that may have additional room for development on them. So that's kind of been the ideal scenario a lot when it's come down to the direct investment side.
Okay, great. I'm going to turn it over to the audience right now. Do you have any questions for this group? Anyone? No? Well, so a little bit. What I've heard today is that partnering with family offices or new investors takes a little patience. You want to pick relationships, not just the capital, so your strategies are very methodical and patient, it sounds like. And I think that's what we've discovered, too. Working with a new family office or current family office or a new investor is really about perseverance and patience. So, we have more questions?
Fadi, you spoke about the group in Dubai that took you a year and a half in order to cultivate that relationship. I'm just curious as to the frequency of the interaction. Were they contacting you? Are you contacting them? And for some of us who are new, trying to try to raise capital through family office or other private investment, what is that frequency that is acceptable to somebody in your position so you're not inundating them and overwhelming them with information, given the amount that's coming through their inbox?
Yeah, I think that's, we're not great at marketing. We don't do any marketing, actually. So usually a group like that, and we have a number of investors out of the Middle East and pretty much all over the world at this point, but they've typically the source, right, they've heard from us from another investor who they know well. So if we didn't know them at all, if it wasn't referred to us, this thing could take 10 years or never happen, right? So I would say a year and a half was actually quick, and because it was a warm referral, right? It helps. Our process is typically, let's jump on the phone with somebody, let's see what they're looking for. Is this even a good fit? This is our story. This is what's your business all about. Is this what you're looking for? If you think it's a good fit, we'll send you our next deal. If you like it, you want more information, we'll send you another deal. If you want to come on a trip to visit the assets, we'll try and set that up for you. I would say we're a very, very transparent group. We'll give them access to the data room. The more information they know, we're proud of what we do. So the more information we can give out, the better, to the right people, to the right groups. And we basically ask them, how do you want to stay in touch? You want us to send you our deals? You want give us a call when you have questions? This one in particular, I was in London a couple of weeks ago, and I was trying to meet them in London because they do business in London. We couldn't meet, so we did a phone call. And I said, well, we've been talking for a while. How interested are you guys? And they say, very. We just want to know what deal to come in on. So, well, that's not tough. That's an easy one. We could just figure out the next. So I think the best thing to do in our experience is just ask them how often do you want us to stay in touch? Do you want to call us call you, send you, ask them. It's not the same for everybody.
Thank you.
Any thoughts, Jacques?
Sometimes I find that having a schedule where you create interest and then you give them the space to find out if they're responding or if you need to take them to the next action, that gives you the knowledge of knowing where they're at. So if they don't respond to you, then you say, okay, so the ball's in my court. I need to take the next action. What would a meaningful action be? And just always engage with them and then find out from them what their next action is before you take one. And then after a while, ask them, so what would you like my next action to be, is very helpful.
I think just blasting out a bunch of emails to people every quarter. How many emails does everybody get? It's way too many emails. So here's our 80-page deal. Let me know what you think. No one's looking at that stuff, right? It's realistic. I don't.
Good point. Very good point. Jacques?
We're actually working with a large investor where we've sent them the deal, and we met with the CEO a week ago, and he had no knowledge of any of the deal points. He's coming to the table saying, we'd like to close this deal, and what would be the deal points? And we kind of looked at each other. We're like, well, we sent them to you. And he's, I don't read email. I'm just ready to do business with you guys. You guys have the deal points now. So we reviewed them there live at the meeting after having, he had asked prior, so we had sent them the deal points, but they don't look at what you sent.
Good point. And Tim, I want to bring something up that you brought up earlier, which is very true. Family offices characteristically aren't into opportunistic deals. They sometimes talk about it, but being a single-family office, you're something about managing risk and never lose the money, if you will. Correct? Isn't that what you're saying?
Yeah, very much so. Opportunistic obviously can be viewed in a number of different directions. I think we are opportunistic investors in the sense that the people let's just take oil and gas again, know that we're able to move quick for certain opportunities that we may know, or a particular basin or a market that we're active in. And so people will know in this last down cycle, we weren't going and signing CAs and barreling through data rooms. We primarily were just looking for relationship-driven deal flow that was even special circumstance that they know that we could come to the table on, but of course we're getting it at a discount, or we're doing something that makes it worthwhile. At the end of the day, though, we're not necessarily if somebody's that we don't know coming to us with a situation that's got to move quick, that's usually a non-starter. We're not going to take the time to dive into something unless it's specific to an area that we're in, or a particular business that it could be a bolt-on to, or a portfolio company. But back to the deal side, how to get family offices' attention. I mean, of course, I hear that a lot at events, from direct deal people to fund managers. And, yeah, I mean, we get, in terms of new deal flow, 100, 200 type of between funds and direct deals and the like a week. And so we do have a system in terms of how that intake occurs. But back to the relationship-driven side, I mean, I'll usually be upfront about that, but we do like to be, we segment our deal flow across the asset classes and even subclasses, so we can go back and look at things that have happened and say, okay, what was going on with these guys a year ago? Okay, I can look back at that project. I can look back at their performance, and it allows us to kind of see things move along from that direction. So yeah, the downside to a family office partner is that they can be very much slower in some cases in terms of being able to get out there or to manage that. I think you're typically going to get a straight answer, though, so you know if it's worthwhile to allocate your time to that relationship. They themselves, or us particularly, don't have a lot of time to waste, so we're going to typically say if something's a non-starter for us. But at the same time, we look to track and follow along with a number of different assets or managers. And of course, we're hoping to be able to continue to identify relationships that we can go long term. I like when I hear things like 80% of our investors are going into each deal. Well, that obviously says that something's working and it's a long-term relationship. None of what we're looking for is going to be a short-term return or gain, so it really needs to be something that we feel we can go the distance with. And trying to build new relationships takes time. So
Yeah,
you can't just go out there and try to do with everybody expecting to be a quick turnover.
Very true. We got a few more minutes. You have any additional questions? No? Well, I think I want to summarize. You've heard some great feedback. One, take your time. Be perseverant. Keep it simple. And manage your risk is probably the best feedback we could provide. I want to thank everybody. Could you please give a round of applause to the panelists, please?